So just last week, the United States has announced that it will impose 10% tariffs on 8 European nations after they signaled their support for Denmark by sending small troop contingents to Greenland. And by June 1st, if no deal is reached for what President Trump has called the complete and total purchase of Greenland, these tariffs will further rise to 25%. What makes this situation highly unusual is not just the tariffs, but who they are aimed at. All 8 countries are long-standing US allies and members of NATO. So how did we get here, and why does Greenland matter enough for the US to risk this kind of fallout? What's interesting is that this isn't the first time Trump has looked at the idea of US buying Greenland. Back in 2019, during his first term, he openly mentioned that he was considering it. At the time, most people treated it as a joke, but even then, this wasn't some brand new idea that came out of nowhere. Instead, American interest in Greenland goes all the way back to as early as 1867, where the former US Treasury Secretary Robert J. Walker argued that the United States should consider Greenland as part of its broader expansion strategy. However, nothing came out of it at the time, and no formal was made. Then, it was only right after the Second World War that the first serious attempt finally came. In 1946, President Harry Truman formally offered Denmark $100 million in gold for Greenland. The reasoning was straightforward. Greenland sat along the shortest route between North America and the Soviet Union, making it a critical location for early warning radar, bomber detection, and Arctic defense as the Cold War began. While Denmark ended up declining the offer, in 1951, Denmark and the United States ended up signing the Greenland Defense Agreement, which allowed the US to establish and operate military bases on the island. This led to the expansion of the Thule Air Base, which became a key hub for missile warning systems, space surveillance, and Arctic operations throughout the Cold War. So, if the United States already had military bases on Greenland, why does it want more than just access today? What has changed is the strategic context. Today, the Arctic is no longer just a frozen defensive buffer. As its ice continues to melt, Greenland is quickly turning into a space where countries are competing for shipping routes, resources, and influence. First, shipping. Melting ice is opening routes such as the Northern Sea route, which can reduce transit times between Asia and Europe by as much as 30 to 40% during parts of the year. And that's not just about saving fuel. If you can monitor and control Arctic checkpoints, you can gain leverage over trade routes, narrow movement, and supply chains. Second, resources. Greenland hosts some of the largest undeveloped deposits of rare earth elements in the world. These materials are essential for electric vehicles, wind turbines, advanced weapons, and high-end electronics. On top of that, there are potential offshore oil and gas reserves. And with China possessing around 90% of the world's rare earths, that concentration is a strategic vulnerability for the US. Third, military competition. Over the last decade, Russia has been reopening Arctic bases, stepping up bomber patrols, and expanding its icebreaker fleet. Meanwhile, China has declared itself a near-Arctic state and has invested heavily in polar research, satellites, and infrastructure that can serve both civilian and military purposes. And because Greenland sits along polar flight paths and inside something called the GIUK gap, it plays a central role in tracking movement between the Arctic and the North Atlantic. Finally, control versus consent. Even though the US already has existing agreements with Denmark, their operations in Greenland still depend on approval from Denmark and Greenland's own authorities, which can slow things down. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. But then, could the US actually seize Greenland if they wanted to? From a purely military perspective, the answer is yes. The United States has the capability to do so. Greenland has a population of only about 57,000 people, very limited local defense forces, and it already hosts US military infrastructure, including long-standing American bases. So, physically taking the island would not be the difficult part. The real problem is everything that comes after. Greenland is part of the Kingdom of Denmark, which is a sovereign country and a member of NATO. So any forced takeover would trigger a crisis within the alliance. Not just that, it will also severely damage US credibility, alienate allies, disrupt trade relationships, and destabilize financial markets that rely on trust between advanced economies. And this is certainly not a situation like Venezuela, where the United States could just simply fly in, remove a hostile leader, and take over the country. Greenland is not governed by an adversarial regime. It is part of a democratic alliance tied to Denmark and protected under NATO. It also has its own government and strong local identity. So the US can't just give democracy to Greenland the way it has done to other countries in the past. That is why the Trump administration has signaled that it prefers not to take Greenland by force, but instead through a deal. And indeed, in 2019, Trump described the idea of acquiring Greenland as essentially a large real estate deal. According to reporting, officials in the Trump administration have discussed offering direct lump sum $10,000 to $100,000 payments per person to residents of Greenland to encourage public support secession from Denmark and joining the US. Or other estimates suggest that a full purchase of Greenland could cost as much as $700 billion once infrastructure, subsidies, and long-term obligations are factored in. Now, of course, both Denmark and Greenland have made it clear that they are not interested in any deal. Greenland has self-rule, and its leaders have repeatedly said that the island is not for sale. Public opinion backs that up. Polling shows that nearly 85% of Greenlanders oppose leaving Danish sovereignty. But that resistance is not just coming from the Europe. Even within the US, that idea lacks support. A CNN poll found that roughly 75% of Americans opposed to the US attempting to take control of Greenland. That is why the US has shifted toward economic pressure instead. Rather than military force or outright annexation, it is now using tools like tariffs to raise the political and economic cost of saying no, and to force negotiations. Now, even though this pressure is largely aimed at Greenland, the effects are already spilling over. Some of America's closest allies have started looking elsewhere for trade and economic partnerships. The clearest example right now is Canada. Just last week, Canada reached a deal with China to sharply reduce tariffs on Chinese electric vehicles, cutting them from 100% to about 6.1%, and allowing up to 49,000 EVs into the country under the lower rates. In return, Canada agreed to ease restrictions on Canadian agricultural exports, like canola, which is worth billions of dollars a year to Canada. This is not a small adjustment. Historically, more than 70% of Canadians' exports have gone to the US, and yet Canadian leaders have now openly talked about doubling non-US exports by 2035, which will require redirecting hundreds of billions of dollars in trade away from the US markets. And Canada is not alone. After 25 years of talks, the European Union and the Mercosur bloc have just signed a landmark trade agreement. With this deal, tariffs will be reduced or eliminated across a wide range of goods, from European cars and machinery to South American agricultural exports. At the same time, the EU has also accelerated talks with India on a comprehensive free trade agreement. That deal would link Europe more deeply with one of the world's fastest growing major economies, covering everything from digital trade to manufacturing and services. But that's not all. In recent years, central banks around the world have been buying gold at record levels, more than doubling the historical average of roughly 400 to 600 tons per year. This is not a coincidence. By increasing their gold reserves, central banks are deliberately reducing their exposure to the US dollar and US treasuries, and hedging against policy risks, sanction risks, and growing financial pressure. So then, what does this mean for the markets? The short answer is, so far, not much. After all the hoo-ha last year, we now have a fairly good sense of how markets tend to treat tariffs. Most of the time, they see them as a negotiation tactic and not a permanent economic shock. That's why people sometimes call this TACO, short for Trump always chickens out. Where tariffs get announced, markets react briefly, negotiation starts, and in the end, the outcome is usually far less dramatic than the headline suggested. And throughout it all, the market continued to go up. What's also interesting is that when these announcements are often made, many of them, including this one, tend to get announced over the weekend, when markets are closed. That gives investors time to digest the news and cool off before trading resumes. By the time markets open on Monday, or in this case, Tuesday, since today is a holiday, much of the initial panic would have already faded. In fact, according to analysis shared by Subutrade, whenever the S&P 500 gained more than 3% during the turn of the year period, roughly between November 20 and January 19, the markets ended higher 95% of the time, 1 year later, with an average gain of 15.8%, This suggests that seasonality this year may still favor the bulls. Now, of course, past behavior does not guarantee future returns. Markets can always be wrong. So, the real question isn't whether tariffs themselves matter. It is whether they can escalate into something bigger, like military confrontation or war. While that is certainly possible, right now, traders are pricing that risk as relatively low. On poly markets, the odds that Trump will acquire Greenland before 2027 remain low, even though they have been rising recently. At the same time, while the EU has considered activating its 93 billion euro trade retaliation package, it has so far held back. Instead, they have chosen to pursue a diplomatic solution with the US rather than escalate immediately. And if things really did escalate, history gives us some perspective. Historically, war have tended to affect markets far less than financial shocks. For example, while markets fell close to 40% during World War II, the drawdowns during the 2000 dot-com bubble and the 2007-2008 financial crisis were significantly worse. Of course, the world has never gone through a nuclear war, but even if that ever happens, we will probably have much bigger things to worry about than our portfolios. But more importantly, this entire episode highlights a bigger lesson. In a world where trade relationships are shifting and alliances are being tested, global diversification matters more than ever. By investing in a global fund, you are positioning yourself so that your portfolio does not depend on the fates of any single market, government, or currency. History backs this up. Investors who diversified globally tended to survive regime shifts much better. For example, when the UK dominated global markets in the early 1900s, few would imagine its long decline after two world wars. When Japan looked unstoppable in the late 20th century, almost no one expected decades of stagnation to follow. The same logic applies today. While the US leadership may continue for a long time, it is never guaranteed. Global diversification is not about being pessimistic in the US, but rather, it is about not putting yourself in a position where everything depends on one country messing up everything. Instead, it is about making sure that even if the world looks very different 10 or 20 years from now, your portfolio can still hold up. And in a world that feels more uncertain and more fragmented, that kind of resilience is worth a lot.